Clap along if you feel like a room without a roof. Clap along if you feel like happiness is the truth.
Hi, everybody. Welcome to our podcast today. I am being joined by two of my favorite coworkers and consultants in the hospitality and restaurant vertical. We are healthcare consultants, and as we said before, our job is to help employers solve issues on employee benefits and come up with sustaining strategies, because we know that benefits are very expensive. They're second to payroll for most businesses. And this particular business vertical has some very unique challenges. These employers that run restaurants and are in the hospitality industry have unique challenges when it comes to their healthcare benefits. And their benefits are a way to recruit, retain, and attract new talent. So joining me today, I have Jay Wink. And Jay, do you want to introduce yourself?
Sure, I'm Jay Wink, and I have been in the benefits business for about 20 years, and I've been specializing in this for about 10.
Great. And Reed Wagner.
Yes, my name is Reed Wagner. I've been in the insurance industry about 30 years. Jay and I have been partners in this vertical for the last 10 together. And if you look at it, it's about where we spend 80% of our time at this point.
Great. And so tell me a little bit about what makes this industry so challenging when it comes to healthcare benefits, and what makes this industry unique.
I mean, I'll take this one. Where it got complicated was with the rise of ACA. Unlike a lot of other industries where ACA just led to some modest benefit plan changes, we had a lot of customers in this space who basically just stated that it actually changed how we had to do business. And think of all the things that occurred back when ACA hit. You saw the rise of limited medical plans. You saw MEC plans. You saw strategies. We're only going to hire part-time workers, which worked for a while until the employment situation got a lot better and got jettisoned pretty quickly by most of the space. But what it meant is there wasn't any long-term data on what occurs in this sector. And the insurance industry feeds on data. If you don't have data, they don't like it. You think about the old adage that there's never been an underwriter who's been fired for saying no when they should have said yes, but they get fired all the time for saying yes when they should have said no. So the moral of the story is you can manage a program very effectively in this space, but what you're trying to manage is the fact that these plans will have low participation. The insurance market will say, oh, the participation is only 30%. That's normal. You're going to have high turnover. Restaurants have high turnover. Hotels have high turnover. We also bring long-term health care in. They have high turnover. It's a norm. Yet you tie those two together, what does the insurance industry think? They think that big bag boogeyman, adverse selection. Well, what we found is the adverse selection isn't that big a deal when we look at the space, but you've got to have a couple things. You've got to have an underwriting team that specializes in this area. If you take somebody who usually is underwriting in the financial services, the manufacturing area, they won't understand anything to do with this area. And you've got to offer products that both are attractive in this space, which is very different from the other spaces, and protect you from the liability side in this space.
Right. That makes a lot of sense. And I'm sure that everything that you said, so what I'm hearing you say is that you need an underwriting team that can help you explain the risk to the underwriters at the carriers to get them to take this on as a plan.
I'd even, Marybeth, I'd even go a step farther. I would say that you're in all likelihood in a self-funded program in this, and you don't trust the carrier to do the underwriting. You've got to control it with outside groups. The carriers just don't understand what's happening here. So you need a third-party underwriter who can actually handle your budgeting and forecasting.
Okay. Well, Jay, let me throw it to you and ask you what works? What works for employers in this industry?
Well, for starters, Marybeth, we believe that copay plan structures make a whole lot better sense in this sector. As Reed noted, not everyone everyone participates in this plan. So, we want something that's user-friendly. I mean, Reed and I have sat in some meetings before with groups where we've got someone who's been going through cancer treatments and they can't afford follow-up visits because they're in a high deductible plan and they can't afford to go back and see the doctor. So, we don't like that kind of structure. We want something that's going to create win-win where they can afford to go see the doctor, and copay structures are the only way to do that. The second thing that we really try to put in all our plans is a limited medical plan. Once again, you've got groups with limited means. So the idea of having a plan out there that lets them go see the doctors, lets them go see, get some prescription drugs, maybe some tests with no copays, and yet the monthly cost for those kind of plans is, a great fit for groups in the sector. The other thing too is that we like Teladoc. And, again, it's just a great way to allow the people in this sector to go out and get something, for colds, flus, and things along those lines. And, we structured a little bit uniquely because even if an employee buys employee-only coverage, we let them use the Teladoc for all their family members. And that's a great fit because a lot of these people are covering their kids under federally mandated programs like CHIPS. And if they can use Teladoc to go get something for colds and flus, it's just a really nice feature.
Yeah, would that, Jay, something that you said just resonated with me. Would that work for populations of employers with part-time employees that don't qualify for the medical plan through the employer? Could this be offered to part-timers?
Yes, the limited medical plans are a great fit for part-timers. But now what we see there is that people don't really take advantage. We have limited participation in those among part-timers because in reality, if they wanted to work full-time, they could work full-time. Okay. They're choosing to work time because all they really want is the money.
Right. Okay. And Reed, why don't you tell me structurally how, what the challenges are and what the main things that an employer needs to make sure that they put into these plans?
Yeah, I think you're kind of responding to where we sit right now in the COVID environment. And there are three key features out there when I look at a structural makeup that I'd love to say we strategically put them in place in case something like COVID happened. No, we just thought it was right for the hospitality space and we started putting them into our plans. They've happened to, as they bail us out into the COVID world. The first thing is, and this is really true across all industries, it was a great year to be self-funded. The carriers have made more money than they've ever made in their lives in the fully insured environment because with a drop in elective procedures, there just hasn't been much claims activity. That is enhanced in the hospitality space because in the hospitality space, people don't do preventative care, et cetera. And we don't tend to have long-term chronic claimants in this space. These jobs are hard. So if somebody has a chronic health problem, they tend to leave the employment situation and get out. So the claims activity diminished significantly. Again, structurally, be self-funded. Second two things were call centers. We use two with most of our groups. The first one is designed to deal with enrollment and ongoing claims issues, but most importantly, enrollment. What we see is that this employment population, they don't want to be given tools to help them decide what to do. They want to be told what to do. They want to make a phone call and have somebody help them through and say, this is the right program for you. So when we run a program, we'll see in excess of 60% of the population that will choose to call in rather than go in and use the electronic option. The second place is we're using more and more concierge services where employees are trained to, whenever they have claims activity going on, to interact with a healthcare concierge who can coach them through where to get the services, how to do it, can help them out with their bills after the fact. What that's turned out for us in the COVID world, where it's tougher and tougher to communicate with an employee population, is we've got multiple ways now to communicate with these folks. So none of the three were put in place to deal with COVID, but all three have really worked for COVID. We've also seen intrinsically that they work long-term. So I think they're really the future of benefits in this space.
Absolutely. And so most of my clients are suffering right now through the high claimants, right? So to your point, the elective surgeries in 2020 and in general care that was sought was definitely down, way down. But the high claimants continued to drive costs, and something that we're still all trying to solve for. So I'd be interested in hearing from you. Does this sector really have the same challenge with high claimants?
Absolutely. I mean, you know, the cancers occur, you know, car accidents occur, things along those lines, you know, are happening in all of our sectors. But you know, Reed kind of alluded to this. There are a little bit somewhat differences. You know, in a normal industry, you know, high claimants are going to be, a lot of them are going to be based upon demographics. In our world, because there's so much turnover, they're a lot more random. So, you know, unlucky, we got a cancer claim, okay? But that's the way it is. The second part of that too is because, you know, work in our sector is hard. So once that person gets sick, they're dealing with a cancer issue, a lot of them will quit, okay? Because they can't do their job anymore. And also because of their financial situation, they don't typically go on COBRA. It's a lot easier to obtain and a lot less costly to obtain medical coverage from, you know, some kind of federal exchange or something along those lines. And so, you know, if you go that the step further, so what's the implications of this is when our groups are purchasing stop loss, you know, the idea of using lasers or caps and so forth, we can be a lot more thoughtful in how we take advantage of that. And, you know, what it really means to the customer is our budgeting process is going to be a lot more precise, and honestly, it's going to be a lot better.
Great. Well, thank you so much, guys, for joining me today. I appreciated your thoughtfulness. This is a challenging business vertical for sure. You two are definitely the experts on how to look at the risk and design and strategically align the plans with the employer's goals and objectives. So thank you so much for joining me today. And I really look forward to working with you on some of these groups.
Thanks,
Marybeth.
Take care.
Bring me down, I said, 'cause I'm happy. Clap along,